Welcome to the Vaughan Nelson podcast. Today is the second quarter 2026 Vaughan Nelson Select Recap. And with me today is Lead Senior Portfolio Manager Scott Weber. Welcome, Scott.
Thank you, Dan. Um, Last quarter, we described two very different market environments, separated by the outbreak of a war with Iran. The second quarter of this year had a similar split personality, only in reverse. The fear premium that built up through March came out of the market nearly as fast as it went in. And as the acute phase of the conflict seemed to have passed, and it seemed like the worst case scenarios for Gulf energy supply failed to materialize, everything sort of moved up. The S&P put together its best quarter in years. It was up over 15%. And of course, with that, the AI trade came roaring back, with semiconductors leading the charge. You could simplify the whole quarter by saying, did you own Micron and the CPU companies? But there's a little more to it than that, so we'll go through it. Energy over that time period went from being the only place to hide to the worst neighborhood on the block, and it gave back the majority of its war premium as crude retreated. Markets really hate uncertainty, but apparently they love relief. Um, During this time, Select put forth a really strong absolute return that trailed the index by a bit. Um, Looking at attribution and changes to the strategy here, it was a broad rally, and the portfolio definitely participated broadly. 8 of the 28 holdings were up more than 20% in the quarter. United Rentals led the way up over 55%, followed by Illumina and Taiwan Semi, which were each up more than 40%. Um, TSM was our largest contributor to relative performance in the quarter and for the year so far. And healthcare led the sector attribution, with Lilly up over 30%, and as I mentioned, Illumina adding to the gains. Industrials also contributed nicely. Cummins, I mentioned URI. These were positions that we added during the first quarter repositioning. We're up 33 and 56% respectively. Alphabet up 24%, did the heavy lifting in communication services. Nucor rounded out the winners with a 32% gain that made materials a positive contributor as well. Energy was the flip side of that trade. Exxon declined a little over 19% as the war premium unwound, making it our largest single detractor for the quarter. We'd reduced the position in the quarter, but not fast enough to sidestep all of the give back. Technology, that was really the other relative headwind, not so much because of what we own, but because of what we don't own. The index technology sector was up over 30% on the semiconductor rally that I mentioned earlier, and of course, mega cap strength. But our slight underweight to the sector was costly, even though TSM and Monolithic Power both had great quarters. For what it's worth, the software exodus still looks well timed on a year-to-date basis. For example, Microsoft, which we sold in the first quarter after owning it for more than 12 years, is down a little more than 20% for the first half of this year. From a trading perspective, in addition to what I already mentioned, we sold Lincoln Electric and Intercontinental Exchange. We added Southern Company, and late in the quarter added Qnity Electronics. Also during the quarter, Honeywell completed the spinoff of its aerospace business at June 29th, literally the end of the month, into the quarter. And so as you open your statements, you'll see that at the end of the quarter, we owned both Honeywell Technologies and Honeywell Aerospace at quarter's end. Overall, we reduced our cash position a bit during the quarter. Looking at characteristics, this portfolio looks familiar. There are about 28 names, active share in the low 70s, a weighted market cap that's slightly larger than the index, and comparable to slightly higher PE on a price to cash flow basis. ROA remains higher than the index with comparable ROE. One slight shift here after the sharp re-rating of growth expectations at the top of the index. Our expected 3 to 5 year EPS growth using FactSet numbers now screens roughly in line to slightly below the benchmark. For the first time in several quarters, we haven't shown a growth advantage on that metric. We do own some of the same names as the index, but with greater factor diversification and, importantly, higher return on assets. From a factor standpoint, stock specific and to a small degree industry were detractors from performance. So even though Taiwan and Monolithic outperformed, they still trailed the Micron and the CPU companies, which I mentioned earlier. So good performance there, just not good enough relative to some of these other companies. Style returns were positive, and being a little bit overweight beta helped. We were overweight metals and mining, underweight tech, hardware and storage, and a little bit overweight oil and gas. Those dragged. Um, The portfolio continues to show more systemic diversification than the benchmark, with an active risk of about 5.67%. That's typical for us. And stock specific accounts for about 83% of that active risk. Again, all in line of expectations. Stock specific effects drove the performance in both directions. So while TSM was the largest positive idiosyncratic contributor at roughly a little more than 1.5% of the relative return, and Exxon was the largest detractor, industry contribution was negative only because of the technology underweight against a 30% plus sector move. And again, partially offset by the selection of our semiconductors. The portfolio continues to show more systemic diversification than the benchmark. Looking at macro and positioning, that whipsaw of the last 2 quarters is a good reminder of why we don't predicate positioning on geopolitical outcomes. The energy exposure we added amidst the disruption gave a little bit back this quarter, but the industrial materials additions from that same repositioning, Cummins, URI, Nucorp among them, more than paid their way. Idiosyncratic drivers remain our core alpha engine. Meanwhile, the market has picked up right where it left off before the missiles began to fly. Concentrated mega cap and AI-driven leadership, and more to the point, suppliers to that hyperscaler spend are really where the activity's been. We retain a healthy exposure to that theme through NVIDIA, through Taiwan Semi, Monolithic Power, etc. But we're also mindful that a trade this crowded rarely rewards complacency. Supply chains are trying to normalize, particularly with the disruption to the travel through the Strait of Hormuz, but that conflict is far from resolved. The path of inflation and rate policy remains an open question. This kind of uncertainty should continue to serve up opportunities for informed active management, and our intent is to take advantage of them. With that, I'll turn it back to you, Dim.
All right, well, great. Well, thank you so much, Scott. And with that, we'll take a look at returns in the second quarter of 2026. The Vaughan Nelson Select strategy returned 14.22% gross, 13.95% net, and the S&P 500 returned 15.2%, which brings a year-to-date return for the Vaughan Nelson Select strategy to 8.35% gross, 7.81% net. The S&P 500 is at 10.21%. Over the past 1 year, Vaughan Nelson Select has returned 16.85% gross, 15.7% net, and the S&P 500 is at 22.32%. 3 years, 13.35% for the Vaughan Nelson Select gross, 12.23 net, and the S&P 500 is at 20.61%. Past 5 years, Vaughan Nelson Select sits at 10.89% gross, 9.79% net. S&P 500 is at 13.4%. And finally, over the past 10 years, the Vaughan Nelson Select strategy is at 14.95% gross, 13.82% net, and the S&P 500 sits at 15.51%. With that, that's a wrap on the second quarter. So thank you so much, Scott, and we'll have you back again soon.
Thanks.
The views, information, and/or opinions expressed during this podcast are solely those of the individuals involved and do not necessarily represent those of Vaughan Nelson and its employees. Vaughan Nelson does not verify and assumes no responsibility for the accuracy of any of the information contained in the podcast. The primary purpose of the information, opinions, and thoughts presented in this podcast is to educate and inform. This podcast, or any podcast in the series, does not constitute professional investment advice or services, and any reliance on the information provided is done at your own risk. Past performance is not an indication of future performance. By accessing this podcast, you acknowledge that the entire contents of this podcast are the property of Vaughan Nelson or used by Vaughan Nelson with permission and are protected under U.S. copyright and trademark laws. Securities discussed within this podcast may be held in the Vaughan Nelson strategies.